Back in 2020, the price of petrol was 70 rupees in Delhi. By 2023, it now costs 100 rupees. This is a whopping 42% price increase in just 3 years. Pick gas cylinders. It used to cost roughly 600 to 700 rupees. Now it costs roughly 1100 rupees. Pick other critical items, for example, medical inflation, electricity, they have all been growing in double digits post-COVID. Now this price increase has been blamed on COVID by our governments. So is it really COVID's fault that the cost of living has gone up, or is it government failure to control the escalation of price increases that is crushing the back of common people? More importantly, will this inflation turn into a full-blown cost of living crisis which will impact people for decades to come? Let's find out on today's video. So on this macroeconomics case study, I'm going to discuss 3 central questions. Question number 1, who is responsible for the current inflation and cost of living crisis that we are seeing in the world? Question number 2, that can our governments actually handle this inflation, bring it down and resolve the crisis that we are currently witnessing? Third and finally, that if the governments are unable to handle this, then what is it that is likely to happen next, and how normal people like you and me should survive and prepare for a high inflation world. So let's kickstart our conversation and let's quickly discuss that who is responsible for this current round of inflation. Now, in order to understand this, you need to understand 2 central points. First is that what exactly is the meaning of inflation, and second is that how inflation actually happens, because the second point is very less discussed, and for this you need to understand a little bit of economics. So let me delve deeper into both these points. Now, if you look up the definition of inflation, it would be the general increase in price rises. But what we miss is that there is a way the inflation kind of happens. That, for example, imagine that this is the year 2020 and petrol prices are 70. Then by 2021, it goes to, let's say, 80. Then by 2022, it goes by 90. Then by 2023, it goes by 100, right? Now here, what is happening is that, see, the prices went up by 10 rupees every single year, right? But the percentage change is dropping. Why is that? Because here, the base was 70. Next year, the base was 80. Then the year after that, the base was 90. So yes, inflation is coming down. But if you check that the overall prices from 2020 to 2023, the way it has happened for petrol, it has gone up by how much, right? It has gone up by a lot. So when we read headlines like that, you know what, the inflation in the economy is only 5.5%. Well, it could have very well happened that between the year 2020 to 2021, first there was a rise of 11% and now it is only going up by 5.5%, right? So you need to understand that how much has the base prices shifted by. So this is something that people generally miss about inflation. Now, inflation is the rate of change of price rise. Now, price rise can of course come under control. So please do not get super happy when you read that, 5.5% ho gaya, 6% ho gaya. Okay, right? But how much has the prices gone up generally by in the last 3-4 years? Please compute that. So this is the first critical point that you must understand in order to understand the practicality of inflation. Now comes a second more important point, that how inflation actually happens. So for this, you need to understand the basics of supply and demand curve. Now, if you plot it from a macroeconomics point of view, then this is what the textbook definition here would be, that this is the downward sloping demand curve and this is the supply curve. Now, wherever these 2 things meet, it gives the inflation point or the price point. Now, it could very well happen that, for example, if you take a look at this particular graphic, what you would notice is that back when the world was reeling from the World War II scenario, there was very high inflation in the economy. What had happened there? Well, it was a supply shock to the economy. Something similar happened in the 1970s. Again, you can see a spike from this particular chart. Well, the supply shrunk. Now, whenever the supply gets disrupted, this particular curve shifts leftwards. Now, as a result, this point becomes point number 2, and as a result the inflation goes up, right? So this is called as supply side inflation. The second type of inflation that happens in the economy is called as demand side inflation. Now, a classic case of demand side inflation would be the 2020 scenario or 2020-2021 scenario, and what the US government did was that they gave a check of $2,000 to all its citizens. उन्होंने कहा कि ये रहा पैसा, go and spend as much as you want. This is the entire check that we are giving you. Now what happened here? Well, it increased the demand of goods. So what happened here, that if you keep the supply curve constant and if the demand curve is shifting rightwards, then also the inflation can go up. So just to quickly summarize, the inflation in the economy goes up for two reasons. One is that there is supply shock in the economy. For example, it happened post-World War. It happened when the oil crisis broke out. So in such a scenario, there was a supply shock. There could also be a demand shock. For example, here in the 2020-2021 scenario, there was a demand shock that was generated and there was a sudden increase in demand. Why? Because everyone in the US ended up getting a $2,000 stimulus check. Now, the interesting thing is that in the year 2023, governments have been telling us that, see guys, the prices of things have been rising because there has been so much shock in the economy, which has happened due to COVID crisis. Now, okay, when COVID broke out initially back in 2020, 6, 8, 10 months, 12 months, yes, there was a supply shock. That factories were shut. There was hardly anyone going to office. Production stopped, logistics stopped, transportation stopped. So as a result, there was supply shock, no doubt about it. But do you see the same thing right now, or has that shock disappeared now? In my opinion, shock has gone away. Whatever shock happened in 2020, that supply shock is over. It's not as if that supply shock still exists. So why is it that the prices are not going back down? Now, why am I saying that prices are not going back down? Well, the data comes from RBI's Monetary Policy Committee recent meeting. What they ended up saying was that, see, for the next year, the inflation is going to be roughly 5.5%. This is well above our target of 4%. So this is what RBI has said. They had underestimated that the inflation was in control. Unfortunately, as per RBI's commentary itself, the inflation is not in control. In fact, it is going to go higher next year compared to what it was this year. This is what RBI says. Now, a very quick side note, and I'm not trying to make this topic political, that sometimes we feel that, 5.5% is in India. Now in Germany, in other parts of Europe, it is like 9, 10%. So India has controlled inflation. No, you cannot compare India's 5.5% inflation to Europe's 9% inflation, because the way the basket is designed for inflation, the way inflation itself is calculated is very different in India versus Germany and other European nations versus the US. I'm not trying to point here who has done a better job, this, that is for political parties to debate. I'm just simply telling you the reality. The crux of the issue here is that in India, the way inflation basket is designed, almost 40% weight on CPI inflation basket is given to food items. But that is not the case with majority of the European countries. The attribution of food is very limited in the overall inflation basket. So anyways, coming back to the story. So in the year 2023, the governments are still telling that, COVID supply shock has happened. As a result, this supply curve has shifted to left. And as a result, the prices that you are witnessing right now, those have gone up. Well, this is a complete lie. Why? Because this was a temporary supply shock. For example, a classic case in point is the tomato economics that is being played out in the economy right now. Tomato is being sold for 200-250 rupees a kg. Now, this is not the first time that such a situation has played out. Tomato prices spike very often. Why? Because that is a supply shock of tomato, that there is some weather issues or rain issues or poor harvest issues that has happened. So that's a temporary thing. As soon as the production of that commodity stabilizes within the next few months, the tomato prices are going to fall. Now, something similar should have happened in the COVID situation also, that whatever price increases happened, they should have come down. But has that really happened? For example, have the petrol prices come down? Have the egg prices come down? Have the bread prices come down? Has any prices come down? The short answer is no. So is that a supply side inflation problem? The short answer is a no, because that supply shock should have gone away the way it has gone away in several cases in the past. So then what about the demand side? That is it a demand side problem that we are facing, that suddenly the demand has spiked in the economy? Again, here the data tells us that no, that it is again not a demand side thing. It's not as if that the world's population has suddenly grown by 50% all of a sudden, or people have suddenly started to make much more money, all that stuff. So no, it is not as if that this is a demand side problem. In fact, if it were a demand side problem, this is a much easier problem for the governments to manage. So what precisely is happening? That this is not a supply side problem, this is not a demand side problem. So what problem is it? Well, it's a currency devaluation problem. That is what is precisely happening in the economy. So if I show you the data, and here is the data for M1 money supply, and M1 money supply in very easy to understand language simply means that this is the total amount of outstanding liquid money that is there in the economy. If you consider the 2020 data, it will come out to be roughly 40, right? And right now it is close to 60. So how much has the supply gone up by? Well, it has gone up by 50% on a base of 40,000. So which is a fairly significant increase in supply of money. So the governments, especially the central banks, are facing a very peculiar problem right now. What they have done is that they have printed a lot more money, be it in India, be it in the US. This has created a lot of liquidity because when you print money, you are going to throw that in the economy. So the governments and central banks have thrown that money in the economy. Now, why have they done this? Because they have to outline the GDP number. GDP itni ho rahi hai, utni ho rahi hai, right? And all that stuff. So the more money you print, you throw in the economy, of course the GDP is going to go up, and an illusion is created that we are exhibiting growth, which we might not be. I'm not here to comment. So what this has done is that this has created more liquidity in the overall money system in India. The problem that government now is facing is that in terms of handling inflation is that they are unable to withdraw this money. So for this, you need to understand the functioning of RBI and its relation with commercial banks. So for example, consider RBI and let's say HDFC Bank. Now, usually what the instruction from RBI to commercial banks are that if HDFC Bank is taking, let's say 1000 crore rupee of deposit, they will take deposit from people like you and me. Then what is it? It's a loan to HDFC Bank. So it's a loan on HDFC Bank in a way from our side. So the HDFC Bank can't take this entire money and lend it out to further lenders. Keep all 1000 crore it picks and lend it out to other people. It can't do that. It has to maintain something called as CRR or cash reserve ratio, which means that it has to, let's say, keep 10% deposits aside in order to meet any requirements where it has to quickly repay the loan or you come and ask for a withdrawal of money, all that stuff. So this is how generally the way the banks function based on this CRR. Now, in the recent Monetary Policy Committee meeting of RBI instructed the bank to maintain something called as incremental CRR. In case you want to understand what this is, here is a note. I had written this on member community of YouTube also. In case you're a serious investor, you want to learn about macroeconomics, how to relate it to finance, how to relate it to stock market. I give very extensive commentary so that you do not panic whenever the market falls, and if there are good opportunities, I discuss all those points as well. In case you are purchasing my course, then in that event, you don't have to purchase this member community. It will come free with that course for a period of 1 year, right? So please note that. You will find all the links to join it in the description and comment box. So anyways, coming back to the topic as to why this incremental CRR was reintroduced, it is very simple that there was excess liquidity in the market and banks or commercial banks were saying that, you know what? We are not going to do reverse auction with you and we are not going to place our money with you at this point. So RBI gave a mandate that no, you have to do it as per the incremental CRR rule. Basically, the commercial banks received a lot of 2000 rupee note ban. I'm calling it a note ban because de facto it was a note ban. So whatever money you have received, it increased your liquidity. You have to maintain it. So to cut the long story short, what is happening in this entire game is that it is becoming more and more evident that managing this excess liquidity and withdrawing it from the market is proving to be difficult for central banks, not only in India, but also across the globe. If I delve deeper into this topic, this video itself will become like, 1 hour. So I don't want to get into that, but I at least hope that you got the basic concept. This is going to be a complex video. Please watch it. It is going to help you out a lot in terms of understanding the entire thing. Also press the like button if you haven't pressed it. It will allow these type of videos reach out to more people. So to cut the long story short, that if excess money is printed and if the government is unable to withdraw that liquidity in a timely manner, it will lead to something called as currency devaluation. Now, what is the meaning of currency devaluation? It is very simple that, for example, if with 100 rupees, you could have purchased one apple back in 2020. Now you can buy that same one apple at 200 rupees. So basically in this example, the value of money or purchasing power of money to buy an asset called as apple has come down by 50%. So to cut the long story short, Who is responsible for this current bout of inflation? Well, it is government's fault on two levels. One is that they have printed too much money and now they are unable to withdraw excess liquidity, which is leading to a currency devaluation. So the next time you hear the argument that, hey, it happened because of COVID, no, it was a supply shock which should have gone away and the prices should have reverted to their normal level. But that is not happening. It is simply happening because there is a lot more money circulating in the economy, which keeps on devaluing our currency, be it the US dollar, be it INR. Funnily enough, US, a country that has printed the most amount of money, its currency has strengthened the most. Why? Because during such times when there is excess debt in the world, it creates a lot of panic in the world and a lot of money shifts to the US. And as a result, the US dollar strengthens. So that is the entire story, and government's precise fault is at both these levels, on money printing stage and inability to withdraw this liquidity sensibly. So now comes the second question that, hey, okay, fine, this is a mistake. Can it be solved? And is it even creating any problem? Because my salary might be increasing at the same level at the rate at which the currency is getting devalued. For example, in 2020, if I used to buy one apple at 100 rupees, and now if I have to pay 200 rupees to buy that same apple, what if my salary doubled in these 2-3 years? Then is it not offsetting inflation? So very good question. And for this, you need to understand the concept of cost of thriving. Now, the data in India is not clear because most of our economy is unorganized. So that clear data is not there in India. So I've picked the data from the US because whatever happens in the US, it kind of percolates to India also. So the data in the US, there are two data points that I will share. And let's look at graph number 1. And here we are talking about 4 or 5 critical items. For example, housing, health insurance, transportation, college education. And what this graph typically shows is that, see, back in 1985, this gap that you're seeing is the kind of a saving gap. For example, someone, an individual working in 1985 for 52 weeks, they could afford housing, they could afford health insurance, they could afford transportation, they could afford college, and they could also save a little bit of money. Now, this thing has been completely wiped out by the year 2018, which kind of proves the point that, you know what, money is getting more and more devalued by every single year. The next data point is even more mind-boggling because it gives you a more granular picture on this entire cost of living crisis. Now, here is the data from 1985 to 2018, and it shows that how much weeks worth of salary you had to save in the year 1985 to buy an average house in the US. So the cost of an average house in the US was $13,500 US, and you could make that salary with 30 weeks of work. And by 2018, you had to work 53 weeks in order to afford a house, which in 2018 used to cost 54,000. So that was the average price of a house in the US. So to cut the long story short, as the currency gets devalued, the ability to buy real assets become harder and harder. That is one of the reasons why you are seeing that, for example, in our parents' generation, even if they were having okay jobs, not very high salary, लाखों में नहीं होती थी salary, but still they used to build their own homes or could have easily bought a car, could have easily raised kids. But what about like 30-year-olds right now, right? Most of us do not have a house. Most of us, even if we are buying a car, it will be on some kind of a loan, right? On top of that, people are really questioning, you know what, can we even afford to have kids? So what does this show? It simply shows that our currency has been devalued. We can celebrate the fact that, okay, we are getting more and more salary, but honestly, even with that increased salary, even if you include PPP, it is still not able to buy more assets for you. So what is government doing about all of this? And what is the government's grand plan here? Well, in the past, whenever inflation has happened, what governments typically do is that they go on increasing the interest rate. They increase the interest rate so much that this demand curve is shifted leftwards, that there are fewer and fewer people who will demand things. For example, imagine this, that if you are getting a home loan at 15%, will you go and buy houses? If you are getting an iPhone loan at, let's say, 25%, will you go and buy an iPhone? You'll say, nahi yaar, there's no point in doing that. So you will not buy. So that is what the impact of interest rate on the economy is, that it can help shift this demand curve leftward, and as a result, it can bring down the prices. But here is the funny part now in the year 2023, that if you read the recent commentary by the US government or by the Indian government has paused rate hike. Inflation problem hasn't really been solved. So we are not increasing the interest rates anymore. This is point one. Even in the US, they have increased the interest rate previous 2 times, but now the indications are coming that it's going to pause or it's going to cut. So it's only the European government that has taken the harsh step of increasing the interest rate beyond 6.5%. But if you look at history, and let me show you the history also, that when we witnessed fairly high inflation here, what was the interest rate? Well, the interest rate was jacked up all the way to 20%. So to cut the long story short, in the year 2023, we are sitting at a time where the governments actually tremble even if they increase interest rate to like 10%. They don't even have the ability to do that. Why? Because it is going to shrink something called as growth, which will reflect into elections. And then everyone cannot make the halla gulla that our economy is growing at X%. It will become like $50 trillion economy. It will become like $500 trillion economy. All that unfortunately is fake growth. In fact, if you study the last 10-year history, what you will notice is that we existed on that roughly 0% interest rate world. In an ideal world, if the government had its way, it would bring down this entire thing to 0%. But it is very, very unlikely that they will be able to do that anytime soon. The consensus in the economic world is, and what major economists are telling us, that we will plateau at somewhere around 3% and we will transition to something called as high inflation and high interest rate world. Now, what kind of impact is it going to have on the world? In fact, in the short term. So let me very quickly speak about that. Now, depending on how you think of the short term, I will think that next 5 years could be considered as short term. So here is what is going to happen next. In fact, it has already started. The first data point shows the cost of financing. This is the yield on corporate bonds. Corporate bond yield simply means that, for example, if ITC is now taking loans at 10% rate of interest, then what? Then it means that they will have to repay loans at 10% interest. This is fairly high. So if you study the last 10-12 year history, the corporate bonds average yield is somewhere around 7.5 all the way to 11%. Now, this is data point 1, that a lot of high interest rate debt is already being taken in the economy. Now, the second and the most problematic scenario is that most of this debt is going to mature by 2025 all the way till 2028. So this is where defaults are going to happen. When you see small cap, mid caps, regional banks in the US, why are regional banks collapsing in the US right now? Well, because they had invested a lot of money in government bonds, which turned out to be really bad debt. That was the classic case of First Signature Bank and Silicon Valley Bank. Some more regional banks are going under as we speak. This problem is going to come to India also. And by the year 2025-2026, you will start seeing a lot more companies defaulting on their loans. So then comes the final question, that what is it that you and I should do as an investor? So as I earlier explained, that please learn about hedging. This is a very important aspect. Number 2, aggregate assets as fast as you can. Please stay diversified. I keep on saying and explaining it on almost every single of my video that please be a diversified investor. People laugh at me that Akshat, you have like 50 stocks, 60 stocks. What kind of investing is this? Honestly, guys, if you are a macro investor, you need to have broad bets. Every single macro investor or majority of the macro investors make broad bets. It's easy to maintain that portfolio, and especially like at my scale, when I'm investing a lot more money, having 50 to 70 stocks works for me. Please learn a little bit about options, that how you can use options to hedge your positions. Last time I did a video, a lot of people commenting that you are encouraging people to trade on options. Nahi bhai, I'm not encouraging you to trade in options. I am asking you to learn about options from a hedging point of view. These two are very, very different things. I don't want you guys to become options trader. I'm simply requesting that learn how you can apply options in order to hedge your portfolio. So as the next step, I would recommend that please go and watch this particular video on hedging techniques. This will teach you a lot as to how you can hedge your portfolio and do not make bad bets in the market. I hope you enjoyed this conversation, and I'll see you soon.